Hello everyone, my name is Vikas Agrawal and I am the founder of AIF and PMS Experts India. Well, AIF and PMS Experts India is one of the largest platform now as we speak in terms of investing in alternate investments and portfolio management services. So our endeavor is to sort of educate and empower the investor community, and therefore I'm sure some of you who have been watching our shows might be familiar with the fact that we keep organizing these knowledge-based sessions, and we call it Ask the Expert Show. And the whole idea of organizing this show is to share more knowledge with all our investors so that they can take the right decision and attain their goal of their life, whatever they wish to achieve. So, we are happy to sort of come back, and with me I have Mr. Gautam Baid. Well, he doesn't need any introduction because, he's sort of well-known face on most of the TV channels, and he's also an author of Joy of Compounding book, which is one of my favorite book. I would have read that book at least 7 to 8 times in last almost 4 to 5 years time, ever since the book was launched. And that gave me a lot of wisdom to think about what is called real joy of power of compounding, and also gave me some more perspective about how do you sort of live your life and add more value to people. So that has been the inspiration. So it's a very special day for me because I'm going to read his mind today, and I'm going to sort of ask a lot of questions on your behalf. So let me have the privilege of introducing Gautam. So Gautam Baid is a chartered financial analyst, CFA, and he's also the managing partner of Stellar Wealth Partners India Limited, India Fund, Delaware-based investment partnership which is available to accredited investors in the US. And Gotham is also the equity advisors of Stellar Wealth PMS, a portfolio management services which is available to Indian citizens and as well as NRIs, both domestically and globally. Both funds are modeled after the original Buffett partnership fee structure. Invest in Indian equities with a long-term, fundamental and value-oriented approach. He is one of the biggest follower of Warren Buffett. In fact, he wrote letter to him, and in turn, Warren Buffett for the first time, wrote letter back to him. So that's something I would say is an achievement, by interacting with him. So previously, Gautam served as portfolio manager at Summit Global Investments, and SEC registered investment advisor based in Salt Lake City, USA. Before that, he served at the Mumbai, London and Hong Kong offices of Citigroup and Deutsche Bank as senior analyst in the investment banking teams. Gautam is, as I mentioned, is an author of international best-selling on value investing book called The Joy of Compounding. In 2018 and 19, he was profiled in Morningstar's Learn from the Master series. So he's been sort of there on, as I said, most of the TV channels in India. He's managing funds based out of US, and also he's recently became part of Complete Circle Stellar PMS, where they recently had a launch meet, and today I'm going to ask him what was the reason for him to get into Indian domestic PMS. So with that, we'll not waste the time, and I would like to interact with Gautam. So Gautam, thank you so much. You've come all the way from US to India, and then you could manage to find some time from your busy schedule and coming all the way from Delhi and talking to us in Pune. So thank you so much for, first of all, for accepting our request and agreed to speak to our investors.
Thank you for the warm introduction, Vikas. Right?
Yeah. So Gautam, we know each other because we met at Berkshire Hathaway's AGM long back, and ever since we met, I've been following you. I've been and learning a lot from you. I would say your tweets and your LinkedIn post. It always inspires me because you always add a lot of value to people. So my first question to you is, what made you to get into Indian PMS industry and start the PMS?
So I launched my India fund based out of the US 7 months ago, and that was available only to US citizens. So I was receiving a lot of letters and emails from NRIs and Indian citizens that you have launched a strategy for US citizens, but we would also like to participate in your investment philosophy. So recently I met up with the founders of Complete Circle Wealth Solutions, Gurmeet and Kshitij.
Yeah.
And we really connected in terms of our common philosophy of long-term thinking, our bullishness on India, a focus on quality, and I decided to collaborate with them by joining them as an equity advisor on their investment committee.
Right.
And we launched our Stellar Wealth PMS strategy just a month ago.
Right.
And the initial response has been very encouraging.
Right. So there's a saying that if you are with the right people at the right time, only the miracle takes place. And I know Gurmeet and Kshitij for quite some time. In fact, me and Kshitij, we are good friends. And what I seen is that Gurmeet is very data driven, very good at fund management side now. I mean, his analytical ability to sort of analyze various industry is only going up the day by day. Like, I know him for many years, and I have a lot of respect for both of them. So great, you've joined Complete Circle. And so tell us something about this fund, the fund that you are launching. What was the reason? So what was going on in your mind when you talked about, because Complete Circle is already running digital compounders. In fact, I'm one of the investors there. Really have a lot of faith on both the gentlemen. And the team is also very warm, doing fantastically well. So how different your fund is, and what was going on in your mind when you decided to sort of come along with them and launch this fund?
Right. So digital compounders, like you rightly mentioned, they were already running that strategy, but that's primarily a large cap strategy. 65 to 70% of that particular strategy is large cap, whereas Telewealth PMS is primarily a small and mid cap strategy coupled with special situations. So the founders of Complete Circle thought that this is a great complementary product offering to their existing clients.
Right.
That is why we decided to collaborate, because now our product suite is complete. We have a large cap strategy, and now we also have a small cap, mid cap, and a special situation strategy.
Right. But in terms of the framework, both are multi cap, right? Like, although it might have 60-65% large cap, but then it has the flexibility to move around. Like, tomorrow it can get into mid and small cap also. But what about your strategy?
So my strategy is also a multi-cap strategy, but at present the portfolio that we have is 65 to 70% small and mid-cap with the balance in special situations, but we are market cap agnostic. Right. So we go wherever we find earnings growth. Let's go back in time from January 2018 to April 2020. For those 28 months, small cap, mid cap stocks were out of favor, but they were out of favor for a reason, because there was no earnings growth in that particular category. Right. And that is why large caps and high quality outperformed during those 28 months. So we are very flexible. To succeed in this business, you have to be nimble, open-minded, and be willing to adapt all the time. So we will invest our clients' money wherever we find opportunity and wherever we find good earnings growth. So after a long time, especially after the end of the recent earnings season, which was one of the most eventful in a very long time, I think it's one of the best times to be a bottom-up stock picker, because in this market, if you closely observe, bottom-up stock picking is being rewarded handsomely. Companies with strong earnings, bullish management commentary, and wherever business fundamentals are improving, only those stocks are being rewarded, while the rest of the market languishes. So the good old markets like we know them. So this is one of the best times to be a fundamental research-oriented investor.
Right. So before we come to your investment philosophy and how do you select stocks, etc., let me come to you directly, because this is the question which is being asked by my investors many times, especially in last 6 months to 18 months time. One, because you come from US, so how does what are the views of these FIIs in India, because they've been net seller, and April was the first month when we saw some net sell coming in.
Correct. So basically for the last 1.5 years, as we have seen, FIIs have sold more than $35 billion of equities in India. But a large part of that outflow is basically emerging market basket selling. So India is part of the MSCI Emerging Markets Index. So whenever FIIs sell emerging markets as a basket, India also witnesses a lot of selling. Apart from that, during periods of uncertainty, FIIs like to gravitate to the mother market, which is the US. That's why we have seen a lot of strength in the US market. And we have seen a lot of outflows from countries like China, Taiwan, India, and a few other emerging markets. These FIIs will make a comeback to India. They are structurally very positive on India in the long run, but they are very tactical in nature. A lot of these FII flow is a lot of ETF hot money flow as well, which are very tactical in nature. So I think we should just ignore the short-term noise and focus on the long-term fundamentals of companies. We have to appreciate the fact that in spite of $35 billion of FI selling, we have the Sensex at 62,000 index, right?
True.
So let's try to imagine what's going to happen the moment the FIs make a comeback. In the last 1 month, we have seen, in fact, in the last couple of weeks, we have seen a lot of FI buying returning. And I think the tide may be turning after a lull of 1.5 years.
True.
The key mistake which many retail investors and even some high net worth individuals do is that the moment they don't get returns from equities for 1 to 1.5 years, they tend to lose faith very easily, and then they talk about fixed deposits and real estate. But this is primarily the very time when you should be increasing your allocation to equities, because history has taught us that whenever people start talking about the superiority of fixed deposits over equities as an asset class, those historically have been the best time to increase your allocation to equities. So what's important as a fund manager or as a PMS house is that we continuously educate our clients at the time of onboarding them and also after onboarding them. I think the continuous ongoing education program is very important, because
you need to handhold them.
Handholding is very important because most of investing is behavioral.
True.
All the great long-term investors, they not only had the analytical edge, but more importantly, they had the behavioral edge. They were able to maintain a very calm temperament, a mature temperament, and stay the course for long-term wealth creation. That is what we expect from our clients as well. So whenever I talk to any of the clients before onboarding, I always try to set the right expectations. I think setting the right expectations upfront from equities as an asset class is very important. One more thing which I do with them is, in the past you gave a very good presentation on history of Indian stock market volatility. I make it a point to share that video with all my clients because they are educated from the very outset that volatility is a feature. It's not a bug of stock market investing. So that is the price which you pay for superior long-term returns.
No, in Hindi there is a saying कि share market के स्वभाव में उतार चढ़ाव है. So obviously one has to bear it. Cannot be fixed deposits that keep giving you returns every year. Now coming back to your experience, because you spend time in India, you spend time in US, you interact with most of the hedge funds also, hedge funds managers. So tell me what's happening in US, because US we're hearing that recession has begun and the market caps, like there also we saw 30-35% of correction and now it is getting stable. So what's your views on that?
So again, the market has become very discerning, and wherever there is good quality of earnings, those stocks have hardly corrected. Look at Microsoft and Apple, they are at all-time highs. Whereas all the unprofitable tech companies, those are the ones which crashed. So in an easy liquidity environment, of zero interest rate environment, every stock goes up irrespective of fundamentals. But the moment cost of capital goes up, markets differentiate. That is what is happening in the US. The same thing is happening in India as well, where only the good stocks are getting rewarded, whereas the stocks with bad fundamentals, they're languishing. So the market is very clearly differentiating between good quality and good growth versus bad quality and no growth.
But they just say, a lot of people say that anything happens in US, India is so sensitive markets. India is the first one to start correcting anything happens in the world. So what's your sense like? Do you think that the level of maturity has gone up as far as Indian investors are concerned? A. B is that overall size of the market has become large or comparable according to you?
The answer to your question lies in monthly SIP flows. Who would have thought we'll see a day when monthly SIP flows cross 14,000 crores. That is providing a tremendous cushion against any volatility from FI outflows. That is the inherent strength which we are getting, and even today the penetration of equities among the Indian public is still very low. As this keeps going up over time with increasing financial awareness, there will come a time when we will stop talking about FIs altogether. We'll become an Atmanirbhar Bharat, so to speak, in our stock market as well. So I think that's just a matter of time. The direction is very clear, and the initial trends are very encouraging.
And we've been hearing this G20 presidency thing which is happening in India. It's a very big theme now, playing out very well. Our relationship with other economies are going up and deepening up day by day. So you think that we are all set to become third largest economy in next 4 or 5 years time?
There's no doubt in my mind that India is all set to become a global superpower, and that the first, but to reach that particular level we have to become more diversified economy. We cannot just depend on services. Manufacturing also has to be a very important part of becoming that superpower, that piece of becoming a superpower. So I want to share some hard numbers with you just to illustrate the trend.
Because manufacturing is not shaping up in India.
Yes, but the initial trends, the numbers basically give everything away. So I want to share some hard numbers with you. Let me give numbers from 3 or 4 industries. I'll talk about mobile phones, tiles, ACs and chemicals. So in chemicals 5 years ago, India had a 1.5% global market share of global chemical production. Today it is 3.5%. That's about chemicals. Now
chemical is special chemical?
Overall chemicals. Including commodity and specialty. So from 1.5 to 3.5, in percentage terms, you have basically more than doubled.
True.
Right? Second, tiles. So in Morbi in Gujarat is the tile exporting hub of India.
Right.
5 years ago, the annual exports of tiles from Morbi was 4,000 crores. The most recent financial year, it has crossed 17,000 crores. So look at the traction in our production of tiles and our export to the world in the tile sector as well. Number 3, mobile phones. The most recent year, Apple has exported phones worth more than $5 billion from India. Foxconn and other global manufacturing giants are setting up their plants in India. So even in mobile phone manufacturing and exports, we are becoming a very strong player in the world.
Yeah.
So, and now finally, let me talk about air conditioners. Till 5 years ago, 80% of India's air conditioning manufacturing requirements was imported. So the indoor unit, the outdoor unit, the compressor, all was imported from China. 80% of that was imported from China. Now look at where we stand today. That entire ratio is reversed. Now 80% of the indoor units, outdoor units and compressors for air conditioners are manufactured in India itself. So I just mentioned about 4 industries. I'm sure there must be scores of many more industries in which this trend is very visible. So we just have to continue and build upon all the reforms of the government over the last 10 years and just continue the good work. India, in the past we used to get in our own way. Basically we used to call them, self goals. But thankfully, those things have not happened in the last few years. We are very clearly on a growth trajectory and a very reform mindset.
Right.
I think we just need to continue on this path, and the end result will take care of itself.
Right. Great. I think, the way things are shaping up in India, I mean, in fact, CEO of Apple, he was in India few weeks back, and he talked about his roadmap in terms of having strategic alliance with economy like India and contribute, export 25% to 50% of the overall manufacturing from India alone. So that's the kind of commitment coming from these big businessmen. So obviously we see huge demand coming up. The other thing I want to talk about is, so now I'm coming to the fund specific question. So what's your investment philosophy as far as Tyler Wealth PMS is concerned? Number one, and second is, what all things that you look at when selecting stocks, and what all things that you'd like to ignore while investing?
Sure. So before I talk about the investment philosophy, I would like to share something about fundamental investing in general. And we all keep searching for the holy grail of investing.
Sure.
And I feel that after many years of research, I have understood what is the actual holy grail. So in this stock market, there are 2 kinds of companies: companies with low returns on capital and companies with high returns on capital. In case of companies with the low return on capital, the maximum delta, the maximum rate of change, and the maximum intrinsic value creation takes place when they focus on improving their return on capital. And in case of companies with high returns on capital, the maximum delta, the maximum rate of change, and the maximum intrinsic value creation for those companies takes place when they focus on improving their top line growth or revenue growth. This forms the basic premise for our investment philosophy at Stellar Wealth PMS.
Okay.
It's built on 2 key pillars: variant perception and long-term structural trends. Variant perception focuses on companies with low to moderate returns on capital which are transitioning to a higher return on capital, and long-term structural trends focuses on established leaders with high returns on capital which are having good revenue growth. So let me talk about variant perception first. Very, very important. So what is variant perception? Variant perception refers to situations where you get ROC expansion coupled with earnings growth, you get valuation re-rating, and you get multi-baggers. And variant perception comes from having a differentiated view on the medium term trajectory of a business. And there are multiple triggers for variant perception. Number 1, product mix change in a higher margin category. So in those kind of companies which is shifting from lower margin products to higher margin products, the net profit after tax grows at a faster rate than your top line growth.
Right.
And you also get valuation re-rating there.
True.
Number 2, deleveraging. Because debt is a part of capital employed. As debt goes down, your capital employed goes down, ROC goes up. Plus
goes up.
The interest cost which you save on the debt reduction, that also adds to your net profit. So you get faster profit growth as well there. Number 3, operating leverage, which may come from having high unutilized capacity at the beginning of an industry upcycle.
Right.
And you can get this information from management on conference call, what is the existing capacity utilization in their existing plants. Number 4, regulatory change. This is again a very powerful source for variant perception, because if the entire industry's fortunes can be changed by a regulatory change, you get fast earnings growth and valuation re-rating. So last year, as an example, not a stock recommendation but or industry recommendation, but RBI changed the regulations for the microfinance industry last year. They removed that 10% interest rate cap for microfinance companies, and they also allowed microfinance companies to have 25% of their loan book in non-microfinance lending. So this increased the addressable market size for the microfinance companies, and now with the interest rate cap gone, now they can price risk appropriately. And we have already seen a big re-rating of the many microfinance stocks. We hold one of the leading microfinance companies in India in our PMS as well. Until a month ago, that company was available below book value. And whenever you buy something for less than book value, you're basically getting all the future growth for free, as long as the company is earning more than its cost of capital.
Right.
So those are the kind of companies we look to buy, because we get valuation re-rating coupled with earnings growth.
Right.
Fifth source for variant perception, industry cycle shift. So since middle of 2020, the residential real estate cycle in India turned around after more than a decade, and we have seen so many multi-baggers coming from the building material space in India. So very important to track where is the industry cycle shifting for the better, and then place your bets there. Number 6, improvement in asset turns. There are two sources for margin expansion. Two sources for ROC expansion, margin improvement and improvement in asset turns, and between the two I prefer the latter because high margins tend to attract competition. So the improvement in asset turns is also a very good source.
It's a slow process.
It's a slow process, but if you can attend the conference calls and get this insight from the management that what is going to be the expected fixed asset turnover on the new capacity, you can get ahead of the other investors into that particular stock before it actually starts showing up in the numbers. So that's also a source for variant perception. Finally, we have corporate actions like demergers, promoter management change, merger arbitrage. This forms part of our special situations basket in our PMS. I've been investing in various kinds of special situations over the last 15 years.
Right.
But the highest success hit rate came in these three categories: demergers, promoter management change, and merger arbitrage. And these are the three categories which I focus on for our PMS. And finally, divestiture of a loss-making business unit or divestiture of a non-core business unit is also a source for variant perception, because markets like focus management teams, so they reward them with a higher valuation multiple the moment the non-core business is sold off. And if you sell off a loss-making business segment, then the remaining company's net profit goes up, so market cap goes up. So these were various sources of variant perception. These constitute the bulk of our portfolio.
Yeah, so I want to ask, how is going to be the construction of the portfolio? How many businesses you're planning to take, and what percentage of that would be mid and small cap A, and what percentage you will have special situations in that category?
Correct. So again, it all depends on opportunities, but as a general rule, we like to have maximum of the portfolio in long-term structural trends which provide for long-term compounding, and then 30% of the portfolio in these variant perception plays will provide us with that alpha which we want. It's a sector agnostic, market cap agnostic portfolio of 20 to 25 companies.
20 to 25 companies.
This is a ballpark number, and this provides us sufficient diversification while also allowing us to size individual bets appropriately depending on the risk reward ratio as well. At the end of the day, like I've realized over the last 15 years that the unknowns tend to keep happening much more frequently than expected. So to guard against the unknowns happening, I think we should be sufficiently diversified at all times.
Right, especially post-COVID, this unknown to unknown has really gone up big time, and things are changing very fast. So yeah, one has to be very careful. So you're saying that I want to dwell upon your special situations. So how do you approach? Do you keep a track of all the mergers taking place in next 2-3 years time, or you take it as in when it comes?
So when you're full time into the markets, you're aware of all the major special situations that are happening. So in our PMS, we hold a small finance bank which is about to undergo a merger with its parent company. And right now there is a 15% merger arbitrage on the table. And when you're doing this merger arbitrage, you have to take a bet on a call on the underlying business itself. The underlying business has to be of good quality. On top of that, this arbitrage in terms of the gap adds basically like an icing on the cake. So that's one. In case of demergers, there are two kinds of demergers which happen. One is what I call a market cap demerger. The second is what I call a sectoral demerger. So I would like to explain with the help of an example.
Sure.
So a couple of years back, a micro cap stock called Aarti Surfactants got demerged from Aarti Industries, and Aarti Industries was a big size mid cap company with a very high institutional shareholding.
Right.
So when those institutional shareholders got shares of this demerged shares of these micro cap Aarti Surfactants, they started dumping those shares on the open market irrespective of the price, and the stock of Aarti Surfactants fell 50% after listing. So you were able to buy that stock at a very cheap valuation because of this forced selling from institutions. This is about market cap demerger. Now what is a sectoral demerger? So Jubilant Ingravia and Jubilant Pharma-Noma got demerged from Jubilant Life Sciences, and when Jubilant Ingravia got listed, many of the pharma sector funds which were holding Jubilant Life Sciences, when they got shares of this chemical stock, even though Jubilant Ingravia was of a decent market cap, but because it belonged to the chemical sector, those pharma funds, when they got shares of this chemical stock, they were forced to sell it on the open market irrespective of valuations and prices, and you were again able to buy that at a cheap price. So the really big money in demergers is made when you are able to get hold of these shares, demerged shares, in a forced selling situation. So these are the kind of demerger areas that we like to focus on.
Right. So I think so one disclaimer that I would like to give here is that all the stocks, the name that we are referring to is only for education purpose, and it's not a recommendation at all, and you may talk to your financial advisor before you invest in these stocks. Now coming back to point, so you talked about, see, this demerger that you talked about, Gautam, this is well known news in the markets. Like there are other fund managers who are also aware about this fact, but why do you think very few portfolio managers are able to get the much deserved or required advantage and returns out of that? Because this is a common thing, everybody knows, anybody can use the mind and take the advantage of the situation.
So unfortunately, because why the hedge fund industry in America and many PMS, many parts of the PMS industry in India as well, since a lot of the PMS houses become more of marketing firms than investment firms, so they just like to play it safe. They like to sell a very coherent or a strategy which is very easy to sell and market, and they're not really aiming for alpha. But in fee structures like ours, which is based on performance fees,
right,
and which is based on performance, I think we need to think differently from the rest, and in hunt of that alpha we need to look for places like special situations or small cap or mid cap stocks which are not really covered that much by analysts, and we have to go off the beaten path. And I think alignment of interest with the clients is very, very important, and the fund structure, I think, is a very integral part of that.
Right. Since you talked about fee structure, and you also talked about the fee structure of Berkshire Hathaway long back, I want to read your mind. So when you say your fee structure is slightly different, can you talk to our investors and tell them more about this?
So we follow a zero management fee structure modeled after the original Buffett partnership fee structure with a 20% profit sharing over a 8% cumulative hurdle rate. Now this is very important. This 8% hurdle rate is cumulative in nature, which means that in the first year, if the clients do not earn any return, suppose clients make zero in the first year, then at the end of year 2, unless we make 8 plus 8 16%, till that time we don't get paid anything. And we want to get paid primarily on performance, but we do understand that there are clients in the market who also like fixed fee structures because they don't want to do profit sharing. So for them we also offer a 2.5% fixed fee model as well.
Sure. So investor has an option, like he wants to choose fixed fee option, he can go ahead with that, or he can come on variable and share the profit. So there is no conflict of interest and there is alignment of interest rather.
Correct. And the reason for offering the fixed fee structure, Vikas Bhai, is that during a bull market, we have seen cases in the past when a small cap or mid cap PMS, they have gone up 100% in a bull market year. In those specific years, the profit share becomes very sizable.
Yeah.
So some clients do not want to share that sizable share of profit during bull market years. So for those clients, they prefer the fixed fee option. And then there is a third category of clients who prefer a hybrid. So we also offer a hybrid fee structure, 1.25% fixed fee and 15% profit sharing over 10% cumulative hurdle rate.
Sure.
So we have 3 different fee structures to cater to the clientele depending on their preference.
Right. So last 2 or 3 questions quickly. One, so what's your views on the markets at this point of time? As we speak, our Sensex is about 62,000 levels, and now we saw for the first time the FIIs again started buying. So what's your views, and the elections are coming next?
So Vikas bhai, again, every good investor is an ardent student of financial market history, and history has taught us that the year preceding any national election year is generally characterized by very high volatility, because there's a bit of uncertainty about the political dispensation which will come to power in the national election. So I think we should be mentally prepared for some sharp volatility over the next 1 year. On top of that, the US interest rate hiking cycle is about to come to an end, and the debt in the US has gone up to $31.6 trillion, whereas in the last 12 months interest rates have gone up from 0 to 5%. So such a sharp and immediate rate hiking cycle will have ramifications for sure. The Fed fund futures are expecting an interest rate cut in the next 3 to 4 months, and history has taught us that the Federal Reserve, after an interest rate hiking cycle, starts cutting interest rates only when the financial markets break. So as per the Fed fund futures market, we should expect a big market sell-off or something to break in the financial markets in the US in the next 3 to 4 months. That will give an opportunity to bottom-up stock pickers like us to actually accumulate stocks at cheaper prices.
Right. And what's your views on the election of India election? I mean, the Lok Sabha is going to happen on 2024. So
I think the markets will be very happy as long as a stable government comes in power. I think what I've realized by studying the history of the markets is markets don't like coalition government. They just want a stable, full majority government at the center.
right.
As long as that happens, markets will be very, very happy.
So now, as far as your PMS is concerned, so what kind of volatility as an investor I might have when I gave you the mandate, number one, and number two, obviously my question as an investor on behalf of my investor, what kind of indicative returns I can expect, keeping in mind that I'm investing at least for 5 years period? Because if I know for the fact that if it is mid and small cap, the period should not be less than 5 years. That's according to me. So let's keep 5 years as a time frame.
So I'll answer the second part first. So over the long run of 5 years and more, stock prices tend to follow earnings growth. And in our PMS, we look for companies which are growing earnings at 20-25%. Just to be on the conservative side, let me just say that we will be very, very happy if we can get returns of approximately 20% over the long run from our PMS, in line with our expected earnings growth. As regards the volatility, that's very important. So because we invest a lot in small cap and mid cap stocks, the volatility obviously is much more higher here. But when you backtest data and when you look at history, you'll notice that the high quality small cap and mid cap stocks have lower drawdowns as compared to the lower quality small cap mid cap stocks. Now, what do I mean by lower quality? Public sector companies, commodities, deep cyclicals. These are the categories which have very sharp and very high drawdowns during small cap mid cap sell-offs. Last year, the small cap index fell 30% from February to June, and the low quality small cap mid cap stocks fell 40-50%. But if you notice what happened that time, the high quality small cap mid cap stocks barely corrected 15-20%. And at the end of the day, as a PMS house, as a fund manager or as an equity advisor, you have to understand that what actually happens in real life is clients want lower drawdowns and they want healthy returns over time. This is the mantra for having a successful, sustainable, long-term PMS business. You want to minimize drawdowns to the extent you can by focusing on quality and have a diversified portfolio. At the same time, you want to focus on earnings growth so that you can deliver healthy returns. So at the level PMS, we are trying to achieve this holy trinity of lower drawdowns and lower volatility and healthy long-term returns through our focus on quality and a long-term focus on earnings growth.
Right. While I appreciate your thought process, but sometimes what happens, Gautam, is that despite you having right intention, right framework, markets are markets. Markets are smarter than anyone else, and they're the biggest. I mean, I would say that they're the teacher, and we are all student here. My point is, I saw that most of the mid and small cap PMSs go through very difficult phase. Like we saw what happened in 2017, and after that we saw 2018 small cap going down by good 20%. Then 2019 we saw categorization of large, mid and small cap by SEBI, and we saw 80 rupees becoming 60 rupees. By the time it became 70 rupees in 2020, we saw COVID coming in, and the 70 rupees became 37.5. I'm talking about small cap index because I track it very, very closely. So while we think this can happen, but in reality at times it doesn't go as per our expectation. So how do you tackle that situation?
Well said, Vikas Bhai. In fact, from January 2018 to March 2020, the small cap index as a whole fell 55%, whereas the mid cap index fell 45%, and the best of the best fund managers specializing in small cap mid cap space, even they had big drawdowns. So this is a space which is very sensitive to the small cap mid cap index movements. So we do have to accept the fact that these drawdowns will be part of the journey, but this is where client education comes in. You have to educate the client during such times, handhold the clients during such times, explain to them about the quality of the portfolio, the earnings prospects of the portfolio, because you will have these drawdowns. Being when in this space you have this volatility is the price for superior long-term returns. So you do have to accept that fact. At the same time, by focusing on quality and by focusing on prudent diversification, we try our best to minimize the drawdowns for our clients, because I've been a fund manager in my past role in Summit Global in US.
Yeah.
I got a lot of business insights as well about how to run a very sustainable long-term business, because in this business, if you have a very sharp outflow of AUM in a very short span of time, the operating expenses are so high that you have to then shut shop, right? So to build a long-term sustainable enterprise, you do have to focus on client education and managing volatility and drawdowns to the extent possible, while trying to achieve healthy returns at the same time. And all these three things, goals require a lot of hard work and effort.
Right. All right. With that, we'd like to conclude the session here. It was great interacting with you, Gautam ji, and thank you so much. I have no doubt, or indeed I am more confident, that Indian investors will take the maximum advantage by investing in stellar PMS. So wish you all the very best.
Thank you.
Thank you.
Thank you so much.
Thank you.